Housing prices just seem to refuse to go down, and on top of that, the days of getting a mortgage at 3 or even 2% seem to be behind us. So with all that in mind, how much home can you really afford? If you're thinking about buying a new home in the near future, you do not want to miss today's episode. Hey everyone, this is John Boyd, host of the Emerging Wealth Podcast. Thanks for joining us and making us a part of your week. Before we dive in, if you're finding value in our content, please give us a like. This helps us reach more listeners and share quality financial education. Next, I'd recommend visiting our website at www.modernwealth.com. Head on over to our Learning Center. It's packed with videos and articles designed to help you optimize your wealth. While you're there, consider subscribing to our newsletter. Thanks again for being with us. Now let's dive into this week's episode. Welcome back to another episode of the Emerging Wealth Podcast. I'm your host, John Boyd, and I am so glad that you're here today because we're talking about an extremely hot button issue, and that's how much home can you really afford? This is, in my opinion, probably one of the more complex questions that is out there in the realm of financial planning because there's so many different variables that go into answering this question. And as a financial planner, I hate that this is the case. I truly wish it was more black and white because the complexity of answering this question in and of itself spooks a lot of potential home buyers. There's plenty of people that I've worked with in the past that could potentially afford a home, but because they were adhering to one of the billion general rules of thumb that are out there on this topic, they didn't pull the trigger when they easily could have. And the flip side of this is true as well, right? People buying homes that they really have no business being in based off their financial profile, and yet they pulled the trigger because they adhered to some general rule of thumb. So despite the complexity of this question, we're going to try to answer this as best as possible, and hopefully you have a little bit of clarity into how much home you can afford. So as a starting point to answer this question, I don't think it hurts to use a general rule of thumb and build off of that. So let me make that very clear. The general rule of thumb is not going to be your green light to own a home, but it's going to be kind of the foundational point that you'll use and then build off and adjust from it from there. So that starting point that we're going to use is the 28% rule. If you're not familiar with the 28% rule, you are going to take your monthly gross income and multiply it by 0.28 or 28%. The result of this equation is that you should have, in theory, the maximum housing portion of your budget. This is the mortgage itself, home insurance, property taxes, and of course an HOA if you have one. So if your monthly gross income is $10,000, then your monthly housing expenses should be no more than $2,800 a month. Now let me be very clear. This is nothing more than a starting point. Whether you go above this number or below this number to determine how much you can afford is going to vary depending on your personal circumstances. So with that in mind, here are a few different considerations that I want you to have in mind as you build off of this 28% general rule of thumb to find your housing budget. So the first consideration is how long do you plan on staying in the property? If you are buying a home and this is a place where you want to have kids, settle in and establish roots, all that good stuff, and don't anticipate leaving for at least the next 5 to 10 years, then I think you have some flexibility in your housing budget. If you wanted to go right at that 28% threshold or go above that, say have it be 32%, I don't think that's inherently the worst thing in the world. The reason for this is A, the price of a home is less of an issue the longer you own the home. Over time, real estate prices have their ups and downs, and you're giving yourself runway to ensure that you aren't going to be in a position to potentially sell at a bad price and be underwater on your mortgage. And over time, we know that generally real estate appreciates over long stretches of time. In addition to this, your income will likely increase over time. You might not get a 20% bump every year, but most people make a little bit more each year. And because your mortgage is perhaps the largest portion of your housing budget, and that's a fixed expense, that is going to remain flat while your income steadily increases over time. Before you know it, you fast forward 5 years from now, and that home that originally consumed 28% of your gross monthly income now maybe only consumes 18%, for example. Again, how long you plan on staying in the property is really important, because if you plan on staying in that property for a long time, you are giving yourself more time to slowly grow your income. In addition to that, you are giving yourself more time to build equity in the property. And having equity in the property is going to give you more flexibility to shift to a different housing situation without it negatively impacting your finances. The second major consideration, and we kind of touched on it a little bit, but I want to expand on this further because it is so important, is where is your income headed? Yes, in general, most people's income is going to slowly increase over time with little cost of living adjustments that your employer gives you along the way. But your specific future income situation might be a lot more nuanced than this. For example, I remember working with a couple. One spouse did software sales and did pretty darn well, and the other spouse was a first-year resident physician. Their housing budget now is probably going to look a lot different than in the future when that spouse is out of residency making real doctor money. So in this case, they knew they wanted to settle down, establish roots, but they also were very comfortable spending a little more and having the home constitute a little bit more than that 28% threshold because they knew the income was going to be significantly higher in the future. By all means, I'm not saying go crazy and buy a multi-million-dollar forever home and eat canned beans and ramen every night for the next 5 years because you are just waiting for your income to be a little bit higher, or you're waiting for that big promotion so you're not broke anymore. But at the same time, you should use common sense. And if it's pretty darn certain your income will be higher in the future, I don't think there's anything inherently wrong with stretching your housing budget a little bit. On the flip side of this, if you are making really good money, but maybe you plan on having kids and your spouse isn't going to be working anymore, or maybe you're just burnt out on your career and you want to do something less stressful for less money, should you stretch your housing budget if this is the case? Probably not, right? I mean, doing that would mean that you would have to make a certain amount in order to stay in your home. And if your income falls off, you're screwed. So if this is you, if you believe that in the near future, you're going to be in this situation, or if you just simply want the flexibility to make less and take a step back, then maybe having your housing consume less than 28% of your monthly gross income, maybe call it 20% or 18%, is much more appropriate. Another consideration to keep in mind is if you plan on turning that primary residence into a rental down the road. A lot of folks, especially people that buy starter homes, the intention is to rent the place out in a few years and then move and start building a real estate portfolio that way, which I think is fantastic, but it does add a layer of complexity to your housing decision. Simply taking 28% of your monthly gross income as a housing budget might be woefully inadequate. You need to understand what the mortgage payment is in relation to that rental market. For example, maybe your housing expenses are 25% of your monthly gross income, and it ends up being $3,000 a month, which for you is super affordable and allows you to save. However, maybe the rental market for this specific property, you would only be able to rent it out for $2,000 at most. So if this is the case and you plan on moving and renting this place out, you need to either be A, comfortable stomaching a sizable rental loss every month, B, you need to sell the place, or C, maybe consider a different down payment or financing arrangement to facilitate a lower monthly payment so that this property cash flows. Bottom line, when you start to view your home more and more as an investment, these budget rules that are based off a general rule of thumb might not be as applicable because you need to find a way to make the numbers work for future tenants. One final consideration is if you live in a high cost of living area like San Francisco, Seattle, New York, or LA. The reason for this is that to live in a halfway decent home, you could very easily exceed that 28% monthly gross income mark and be more at like 34, 35%. If this is the case, it isn't always a bad thing. For example, because the mortgages on these properties are often larger due to home prices being much more expensive, you generally have much more interest that you can deduct. You also are likely hitting that $10,000 SALT cap in a place like California or New York. So when you combine a $10,000 SALT itemized deduction with, let's say, $35,000 of mortgage interest, that's $45,000 in itemized deductions, which is much higher than the standard deduction for married or single individuals in 2023. That in and of itself could potentially make the housing situation more affordable than it appears on the surface. Bottom line, I know this is a super complex topic with tons of different variables, and to be blunt, we're just really scratching the surface. So if you're feeling overwhelmed, let's make it simple. Allow that 28% rule to simply be a starting point for the conversation. Then sit down and think about what life will be like over the next year. What will life look like over the next 10 years? What will your income look like? What will your family look like? Do you want to stay there long term? Allow some of these questions to guide you in determining if you should go below that 28% threshold or above it. Use common sense. I'm not saying go crazy with spending, but I'm also not saying don't pull the trigger on the home because you want to keep housing at 12% of monthly gross income either. At the end of the day, real estate and owning your primary residence is a huge driver for wealth accumulation in the American economy. The tax code has multiple elements that incentivize this. And unfortunately, it is one reason why the wealth gap in the United States continues to grow. But hopefully what you learned here today will allow you to take control of taking that next step and will allow you to feel empowered in that decision. As a reminder, everything on today's podcast was general education only and not deemed to be specific investment, tax, or legal advice. If you need specific guidance, you can reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. It's been a lot of fun, guys, and I'll see you next time.